How many times have you been told to keep your emergency fund in a high-yield savings account? Plenty, right? But what if I told you there's another option that promises growth and liquidity, perhaps one you're already using for investing? I'm talking about using an app like Acorns for your emergency savings. It sounds tempting. You get the convenience of keeping all your money in one place, and maybe, just maybe, your safety net can actually grow a little faster than it would in a bank. But when it comes to the money you absolutely cannot afford to lose, is this actually a good idea? That's what we're going to break down today. The argument for Acorns. Let's start with the appeal. Why would someone even consider this? Acorns, through their bank partner, offers a checking account that comes with a linked investment account. The idea here is that you're keeping your cash in the checking account for liquidity, but you're perhaps auto-transferring portions into a very conservative investment portfolio. The Acorns later feature might also look attractive. It's a retirement account, which technically isn't an emergency fund, but for some, the tax benefits and growth potential might blur the lines. For a true emergency fund, though, it's the standard Acorns Invest or non-retirement savings feature that people are looking at. The main draw is the potential for higher returns than a traditional savings account, especially in a low-interest rate environment. Plus, the roundup feature could trick you into saving more without really noticing it. The major downsides. Now, let's get into the reality check, and this is where the idea quickly falls apart. Your emergency fund has two primary jobs: to be safe and to be available immediately. 1. Market risk. The biggest flaw is market volatility. Acorns invests your money into a diversified portfolio of ETFs. While you can choose a conservative portfolio, it is still exposed to the stock and bond markets. If you need your money in a hurry, say, you lose your job, and the market simultaneously decides to take a nosedive, your $$10,000 emergency fund could suddenly be worth $$8,500. You cannot take that risk. A high-yield savings account or a bank CD, on the other hand, is insured by the FDIC and its value will not decrease. 2. Liquidity and timing. Job number 2, immediate availability. If you keep your money in a standard high-yield savings account, it's typically available to transfer to your checking account within one business day, sometimes instantly. If your money is invested with Acorns, you have to sell the shares and then wait for the settlement period, which can take several business days before you can transfer the cash to your bank. When you have a sudden medical bill or a car repair, waiting 3 to 5 business days for your cash could be a huge problem. 3. Fees. Finally, there are the fees. Acorns charges a monthly fee, typically a few dollars, depending on the tier of services you use. While this may seem small, these fees can actually eat into the minimal returns you might earn, especially on a smaller emergency fund balance. Most high-yield savings accounts are completely free. The verdict. So, is using Acorns for your emergency fund a good idea? Absolutely not. Your emergency fund is not an investment. It is an insurance policy. Its primary purpose is not to grow, but to be a stable, liquid pile of cash ready to rescue you from financial disaster. For this, a high-yield savings account is still the undisputed champion. It offers FDIC